Episode 482. 3 surprising ways carriers make lots of money. What do plan sponsors and clinical organizations really need to know? Today I am speaking with Preston Alexander.
American healthcare entrepreneurs and executives you want to know. Talking. Relentlessly seeking value.
If you want to save the most money, look where the most money is. You lot listening are like, no kidding, Sherlock. If you want to figure out how to cut down the GDP being sucked into healthcare or the spend for any given plan sponsor on healthcare, look at how much money is being made by Fortune 10 companies like carriers or big, huge, consolidated provider organizations. Their billions and billions of dollars in margin or profit or quarterly earnings or redunculous C-suite bonuses. Let me misquote Jeff Bezos right now. Excess healthcare industry margin is my mission for us to take back for members and patients. And there's trillions of dollars on big healthcare company balance sheets that we can eye up here. Just pull up these big guys' financial reports, which is something that my guest today, Preston Alexander, does on the regular. And all of what we're talking about today is very actionable if you consider it strategically. Now, before we get into this episode, I'm going to quote Robert Sundelius. And he said on LinkedIn, I will link to it, profits are not evil and for-profit companies are not evil. Many organizations that create profits also provide societal benefits. However, when we exploit established insurance or medical care systems to maximize problems at the expense of public health, we are treading a fine line between business and ethics. If you are interested in more along these same lines, I definitely would recommend going back and listening to the episode from a few weeks ago with Dr. Ben Schwartz.
Hi, I'm Dr. Vivian Ho. I'm a health economist at Rice University and Baylor College of Medicine. I listen to Relentless Health Value religiously because this is the show for those who are part of the tribe that wants to improve the quality of healthcare, improve access to care, and make it affordable. So make sure that you subscribe to the newsletter and subscribe to the podcast and keep up with every episode.
Okay, back to the topic at hand, surprising ways carriers make money. Today, I am speaking with, as aforementioned, Preston Alexander. And we're going to talk about, as I just said, not the normal boring ways like underwriting profit. Today, we're going to talk about the surprising ways. And this is important, these 3 surprising ways. They're important if you're a plan sponsor or if you're a taxpayer or a policymaker, because these surprising ways carriers make money are news you can use. They drive carrier behavior in ways that impact you, the plan sponsor, member, or taxpayer. There's probably some lessons in there for some indie physician groups as well. And if you're a policymaker, these are the flags on the top of the hill that carriers are going to try to protect. There's a lot of extremely relevant details that Preston Alexander reveals. But oh wow, I can't stop with the spoilers. So let me tell you the big kahuna of surprising ways they make money off of taking taxpayer or plan sponsor or member dollars and then playing the float, as they say. As much as 20% of some carriers' revenue can come from taking member premium dollars or some kind of capitated payment and then trying to not pay bills for as long as possible. Dr. Eric Bricker made a point on a video the other day that is adjacent to all of this, so I will link to it. But Dr. Bricker was talking about some of these rev cycle, AI augmented, tech the crap out of it promises made to some provider organizations to like increase the speed carriers will pay bills. And Dr. Bricker pointed out, slow paying bills is a feature, not a bug. The slower the carrier pays bills, the more interest they make off the money in the meantime. Like so much in healthcare, getting paid faster is not a technical problem. It's a they don't actually want to pay you problem. A carrier, I just read in 2024, made something like $4.8 billion in investment income. $4.8 billion. I wish I had that money. I'd use it for Medicaid patients. But a carrier with $4.8 billion lying around can use it to, for one thing, buy companies. And then they get even more vertically integrated and consolidated, which allows them more of the second surprising way to make money, which is intracompany eliminations. If you don't know what I'm talking about when I say intracompany eliminations, well, you're in the right place. Listen to the episode and you will. But if you're up on this general concept already, consider 48.86% of United Healthcare premiums went to Optum. UHC, United Healthcare, paid their sister company almost half of their premium dollars. Things that make you go, I will link to an interesting post written by Joshua Brooker and referencing something that Chris Deacon had written earlier. But using these intracompany eliminations for the purposes of, potentially obscuring profits, it allows any so inclined carrier to get even more saucy with the third surprising way many consolidated carriers can make money, which is upcoding in Medicare Advantage for excessive risk-based payments. And those capitated payments are, made upfront. So more float to be had. Nice little flywheel there where the big get bigger. What's Preston's advice moving forward, especially for plan sponsors considering all of this? Critically evaluate relationships with carriers and look for consultants who can offer unbiased expert advice. Every guest lately has been saying the same thing. Andreas, Mang, John Camire are probably the latest, but I think it's come up on the show like 90 times in the past year. Find an impartial, you can trust them expert who understands the intricacies of all of this. This is so wildly important because, regulations slow to change. Policy reform is uncertain. So we all got to sadly listen to shows like this one so that we can competently grab a seat at the table and advocate for ourselves. Because you know what they say, if you aren't at the table, consider yourself on the menu. Also, unfortunately, on the menu are members. And if we're in policy, then all of the taxpayers in our state or district or country are also on the menu if you aren't at the table. But hey, another way to stay off of the menu? Read The Healthcare Breakdown, which is written by my guest today, as I've said multiple times already, Preston Alexander. What Preston does over there at thehealthcarebreakdown.com is he pulls back the curtain primarily for clinicians. But frankly, I'm not a clinician and I find these breakdowns ridiculously insightful. But his goal is to use these insights to help bring back independent practice for physicians looking for a different, better way to practice medicine. And he's also got some really great posts on LinkedIn. So I would certainly follow Preston over on LinkedIn as well. My name is Stacey Richter. This podcast is sponsored by Aventria Health Group. Preston Alexander, welcome to Relentless Health Value.
Thank you so much for having me. It's an honor to be here.
Well, it is an honor to have the Taylor Swift of LinkedIn healthcare writing on the pod today.
Thank you very much. We are big Swifties in this household. It helps me aspire to be the best that I can be by trying to be as cool as Taylor Swift.
Well, I learn a lot from the healthcare breakdown, just the analysis that you do. So thank you.
I appreciate it. It means a lot coming from you.
Let's talk today about the 3 surprising ways that carriers make money. And when we say carriers, this probably means all the service lines, meaning fully insured, Medicare Advantage, ASO businesses, administrative services only for plan sponsors such as self-insured employers. We're not talking about how everybody knows that carriers make money, i.e. charging premiums and et cetera. We're talking about surprising ways that carriers make money. How would you begin our list here?
I think the first one that's surprising is what's called float. Float is a concept and mechanism Warren Buffett kind of brought to the mainstream and loves. He said that I think it's compounding interest is the 8th wonder of the world and float is the 9th. It's something carriers use and leverage to their benefit. The easiest way to think about float, I think, is if you think about a gift card. So if you bought a gift card to, say, Starbucks, because we all need our caffeine to get through the day, you have bought basically the right to buy something later on. And so Starbucks takes the money for the gift card. You've actually paid them, but they know that they're going to have to pay back that value with a beverage at some point. And so what happens is they have the cash, but they put it in their balance sheet as a liability. And because they know they're going to have to pay it out later, but they still have the cash that they can do whatever they want with. Insurance carriers work kind of the same way. So you pay them your premium. They know that they're going to have to pay out either a portion or all of that premium. So instead of just saying, oh, good, a premium, here's a bunch of cash that we have, they record part or most of or all of it as a liability as typically you would find it under current liabilities as medical costs payable. And so it looks like they have this huge amount of debt owed, these huge liabilities, but often a significant portion of their current liabilities is medical costs payable. So they already have the money.
This is where the world of accounting collides and just how an accountant is going to record what's IRL happening out there. And to your point, we could think about premiums being paid as kind of like a gift card. So like if I'm selling gift cards, I have the money. Somebody just gave me $50 for the gift card, but no one's picked up their beverage yet. Now I got $50 that I can do what I will with. I'm sure somebody's got some model that talks about the average amount of, like how long I have to have this money. But the bottom line that you're making is premiums function the same way. I am paid a premium and then I'm going to have that money. And the longer I can delay paying out the medical costs payable, the more I have money to do with what I will before the expenses come due. The way that this is going to get recorded on someone's accounting balance sheet, like the way that the accountants are going to look at it, is they're going to stick all of the gift card total amount, like all those premium dollars over in the liability section. So despite the fact that I have the money, and if I'm just thinking about this like a normal person, not an accountant, I'd be like, wouldn't that be an asset? You're basically saying, no, it's not going to be on the asset column. It's actually going to be in the liability column, which might make a balance sheet look like an insurance company has a lot of liabilities, but some of those liabilities are actually dollars that they have collected, which is very counterintuitive, but that's how it works in accounting land.
Yep, that's how it works. I mean, they do owe that money, or they're estimating that they owe that money, but they're very good at knowing how to use it in the meantime.
So let's talk about that, because we were talking about surprising ways that carriers make money. And what I'm inferring is one of these ways, at least, has to do with how they are using these dollars they have collected that sooner or later they're going to owe potentially, but do not yet. So now I've got dollars in my pocket that I can do with what I will. So what's the first surprising way, given this backdrop?
Yeah. So, and it's what you, I think, alluded to earlier, and we've heard a lot about in, current news, is delaying care. Think about, you have all this money in your bank account or whatever. You want to turn it into more money. You want to get a positive return on any investment, and you want the business to grow. In order to do that, it would really benefit you to have as much time as possible. So in insurance land and carrier land, that means delaying care. That means denials with the hope that they're never fought. That means asking for more information. That means doing all kinds of different things just as a mechanism to delay paying out that money that they have estimated that they're going to owe or already really should owe. And it impacts physicians and it impacts patients. And it's certainly surprising in some ways, but also probably the way that people feel it the most is when they're fighting with insurance to pay for something. And it's because they have all this money that you've already paid, that they have in markets and investments that are earmarked for acquisitions and doing all these things, because they're using that float mostly and the money you've already paid to make as much profit as possible.
What I'm understanding you say is that the first surprising way carriers are actually making money is probably, maybe there's two pieces to this one. One of them is just by delaying the need to actually pay the medical cost payable for as long as possible, vis-a-vis delaying care. The other one here is actually pharma rebates. If you start, Ann Lewandowski was talking about this quite a bit. If you think about the pharma rebates are only paid out at the end of the year. So again, a carrier, vertically integrated PBM, is keeping this money. They get the money up front. They're keeping it for any length of time. They can use that for, as you said, they could use it for acquisitions. They could use it for just any of the number of things that a carrier might want to do with those dollars that they basically have. And the longer that they can manage to keep those dollars, then obviously the more they can do with them while they have them in their possession. So that sounds like number one, like just what can you do with somebody else's money that you happen to have for some period of time? Did I get that right?
Yep. The float is that money that they've gotten and they will eventually have to pay. Mm-hmm. But the key word is eventually. And so where denials come in and we're delaying payouts and we're putting in contracts that you don't have to pay till later, having crazy timely filing rules, it's, can I keep as much money that you've already paid me as I can, even though I owe it back to you. And they use that cash that you've paid, that they know they'll have to pay out eventually, for things like investments or things like acquisitions, or things they know that they can get a return on.
I can make interest off of, again, somebody else's money. Ann Lewandowski wrote the other day, she said the payments, like rebates, et cetera, they're almost like interest-free loans also for faster revenue recognition. I could definitely see that as a financial instrument, just thinking about it in that way. Like there's companies that this is how they make all their money, is by really maximizing the value of dollars and using money to make more money.
Banks do it, right? That's the banking model. You put your money in the bank. It's not in the bank. They are lending it out to other people and making interest on it and on debt instruments. Insurance companies took maybe like a page out of the bank's book, except that we expect to get care. It's a different kind of element. And then they say, oh, you don't really need that, new lung. But it's like, wait, nope, you definitely need that. They just want to wait as long as possible because that money is making 12% in some private equity hedge fund or something.
Yeah, it's interesting. Phil Harrison wrote the other day, another financial something that people forgot about with zero interest rates is the float. And then he wrote, coming back with a vengeance. And I think that's exactly the point that you're making, that as interest rates go up, the ability to have somebody else's money for any amount of time can be very meaningful here.
Yep, absolutely. I think that 0% is a very insightful way to put it.
What I'm picking up from what you are talking about, Preston, is that if someone talks about shared savings, that means that they're collecting money up front and then giving a piece of it back later on, which is kind of another way to say someone's has a float. It definitely sounds like there's some very smart people over at some of these organizations who are trying to figure out all the various ways that they can make money off of other people's money. Okay, so our number one surprising way that carriers can make money is basically using other people's money to either get interest or make an acquisition. That acquisition makes money. We gain more market share. There's just a number of different, if you start really thinking about it, ways that other people's money could be used to further our own ends. And again, even if it's just a 0% loan, that in and of itself is pretty meaningful. So I can see how that could easily top our list, our first most surprising way that carriers are making money here that we could easily overlook. What's our second thing?
The second thing I think about is intercompany eliminations. So this is probably a newer phenomenon, certainly in the last 15 years or so. These large carriers, primarily it's going to be the large ones, are buying care delivery and then basically paying themselves. So if I'm a carrier and then I go buy a medical practice and I inflate the cost of that medical practice's care that it's delivering, then I've just inflated my medical loss ratio and made a higher margin on my business. The scale of it is actually pretty wildly high. So if we look at one example, not to get too bogged down in examples, but in 2025, United Healthcare made $151 billion in intercompany eliminations. I mean, that's a ton of money.
$151 billion they made off of intracompany eliminations. What they were doing there is the insurance carrier arm bought care from their other arm that was actually delivering the care. So they're sort of negotiating with themselves. Like, how exactly do you figure out what the negotiated rate is when you're the buyer and the seller? But that aside, what you're saying is what happened around that table is that the care could be very high cost. And then the carrier can say they're paying very high cost for this care. Therefore, the medical loss ratio is very high. You're only allowed to have 15% profit or something like that. So the underlying costs have to be 80, 85, 90% of what they're paying out. But if the care is very expensive, then you can pay a lot out, right? So in air quotes, your profit is lower, except it's just basically the profit just moved over to the healthcare where there's none of these limits, right? You're just kind of moving money around. And you're saying that $151 billion got shuffled from the insurer, the carrier side of the equation, over to the healthcare side of the equation.
That's right. So it's sort of just like taking money out of one of your pockets and putting it in the other one. If you think about it from like just a simple math, like $100. So if a carrier had $100 in premiums, it's the tiniest carrier on the planet. only $100 in premiums, one healthcare provider, and they charge them $70. And they're like, oops, I didn't spend enough money on my medical loss ratio.
Right, because it's only 70%. So whoops, I just made 30% profit. Oh no.
Let's think about this. What should we do about it? Well, let's go buy that practice and then we'll negotiate with ourselves and say the cost magically went up to $85. And so now I own both. I'm the carrier and I own the practice. The practice charges me. I charge myself $85. I pay it, but then the practice's cost at the end of the day was only, I don't know, say $40. So realistically, I eliminate all the money in between. I got the $100 in premium and I only spent $40. So I went from making $30 to making $60.
And that's where you're saying that 151 billion came from. Just in an example like that, when the care suddenly became more expensive, you can pretty much assume that that's the vertically integrated entity making money.
Yeah. When you see that high of intercompany eliminations, that's like them paying all the care providers or all the other entities or all the PBMs that they own. They're paying them for a service, but then they're eliminating that cost on their side. And so whatever the cost of the downstream company is, that's the ultimate cost.
And this has been brought up numerous times relative to plan sponsors and fiduciary responsibility, because as you know, as we all know, fiduciary responsibility requires that plan dollars be spent prudently, reasonable prices with no conflicts of interest. And if you're hiring a carrier, an ASO, to manage your plan dollars, and that entity is buying services from an entity it also owns, so it's sitting on both sides of the table, like that's pretty much the definition of conflict of interest. That has been brought up any number of times in that context also, just these intercompany eliminations. So that sure, they're a surprising way for a carrier to make money, but that definitely does have implications for plan sponsors who are leaning into like, what does fiduciary responsibility actually mean?
Yeah, absolutely. I mean, a conflict of interest and the inflation of costs, because the carrier's interest, if it owns a company, is to charge itself more. Would always check for fair market value and things like that, because they're often paying themselves far above fair market value, and it benefits them on both sides of the table.
Yeah, that's actually a really good point. And that has been shown on the pharmacy side of the house, actually, which is also often a part of these vertically integrated entities. They not only own an insurance carrier, but they also own a PBM, and some of them own pharmacies. And it's just come to light so many times where they're paying their own pharmacies more than they're paying an independent pharmacy. So I think that's just another side of that same coin.
Yeah, absolutely.
Let's move on.
All right.
What's our number 3 here?
Medicare. And Medicare Advantage.
Said with some ominousness. So let's talk about this.
As one must. Yeah. So the third way, I think is, and this is primarily going to be for large carriers, to be fair, is the Medicare, Medicaid, and Medicare Advantage markets. So Medicare Advantage is highly dependent on risk scoring, risk adjustments, and basically saying, how sick is the population that you are managing? There's all kinds of different ways that a carrier could suggest that the population it is covering is sicker than they are in actuality. Because if they are sicker, they should be getting more money to help, manage that person's care. The problem that we see is that, well, one, there has been some claims made, are these patients actually that sick? And two, and this ties back a little bit to the delay of care. When we have large for-profit publicly traded entities, and not just them, but most for-profit entities are really managed quarter by quarter. And so when they're getting upfront payments for patients who are much sicker or maybe aren't that much sicker, it is in their benefit to hold on, once again, to that money for as long as they can, which in a capitated payment world means just trying to get that patient not to come back. And unfortunately, that will sometimes lead to poor clinical, not from the clinicians, but I'll call it poor clinical influence from the non-clinicians in those organizations that might suggest that a patient doesn't need to come back for 4 weeks when they really should come back in a week's time to check on some issue that they may have had. So we see, and you can look in some of the annual 10Ks of these companies, really the total amount of dollars coming in from Medicare and Medicaid are very significant. Most of the dollars and most of the growth that some of these carriers are realizing comes from Medicare and Medicare Advantage, while they may have a much less significant portion of total covered lives coming from those segments. So I think a lot of people don't necessarily realize how much money the private carriers make off of these public programs and how much they can benefit from tax dollars going into the system.
So the point that you're making in our number 3 surprising way that carriers or these vertically integrated entities can make money is figuring out Medicare Advantage. As you said, it's in air quotes a value-based care program. It's a capitated program. So what that means is that based on some kind of risk-adjusted framework, some kind of math that somebody does, it figures out that this patient is this amount of sick. They have diabetes. They have like how many comorbidities they have. And for a patient of this health status, they should cost this much every year. And then those dollars are sent over prepaid. They're sent over in advance. So as you just said, reference the first thing that we talked about, which is these dollars are collected before they are spent. So same rules sort of apply. The longer you can hang on to the money, the more that money can work for you. So in this particular case, we have the same financial incentives to try to, exactly like you just said, delay care, to not have patients come back, to deny care, et cetera. And because it's a quarter by quarter business in the market, this is exacerbated by real short-term thinking. Like somebody doesn't come back and then therefore there's a big expense a year from now or even 6 months from now, that might not be top of mind. So unless there is a kind of dyad leadership going on where you have a clinician who's like, whoa, if all we're thinking about are what the financial outcomes are, there's certainly some perverse incentives here, I think is the point that you're making.
And I'll say one other thing about it, the rates that Medicare will come out with and the percentages and the adjustments and all the different things that they use to determine how much they're going to pay per patient. They base a lot of it for Medicare Advantage on fee-for-service costs. And this came out last year, the conversion factor went way up because fee-for-service Medicare went way up. But so as fee-for-service goes up, they make those adjustments commensurate with the increases in fee-for-service.
So in other words, a Medicare Advantage carrier is going to come in and say, look, it now costs this much to care for my multimorbid patient, because they're looking at how much the fee-for-service rates are, doing some math there and saying, well, I need more money capitated because the fee-for-service is going up. But meanwhile, they also may own medical practices and are contributing to that rise of fee-for-service. Is that what I'm hearing?
Yes, that is what you're hearing. So in so many ways, in all the different areas, maybe the big takeaway is that insurance carriers, large carriers, aren't actually incentivized at all for medical costs to go down. In fact, it may be quite the opposite. It benefits them the more costs go up.
Just because of the float, the more when premiums go up, again, the way Medicare Advantage works, if the underlying costs go up, the more money that a carrier could wind up being able to collect and then sit on for as long as they can manage to sit on it before they have to spend it out. I can definitely see that that would be the case if they also own practices. It's pretty logical that if underlying costs go up, premiums go up, the higher the float, then again, just relative to the scale of the dollars that are able to be collected, I could also just see what you say is true.
Yeah. I mean, and to be fair, I think we should be fair. It's not like every carrier and every plan and this is like a nefarious trying to not give people the care that they need. We often pick on, obviously, like the big and the bad. And the system deserves a lot of that kind of a thing. But it's not that everybody's out there even sophisticated enough, frankly, to take advantage of all these different things, buying practices and owning the largest surgery center group in the country. It's not feasible. So it is consolidated among a few of the largest organizations, but it doesn't detract, I guess, from the fact that those top 5 command most of the premium dollars in all of healthcare. and impact all of us and employers and fully insured plan, everybody in between, if they're using them as TPAs, need to be aware of these mechanisms because that's how they're going to be able to come back to the table and step up and actually lower healthcare costs, knowing that the incentives are quite the opposite for these large, sophisticated organizations.
Yeah, you're right. I mean, it's definitely one of those things where if you're a carrier at all, like even the most 100% patient first carrier, like if the underlying costs are as high as they are, you have to collect premiums that are going to cover those underlying costs. So it's not like I can just kind of unilaterally decide to have low premiums, right? Like everyone's kind of caught in this cycle. And also that being said, I was reading something that Philip Halauka wrote the other day about captives. Captives and captive vendors also pay interest based on the premiums that are collected. They just pay interest directly back to plan sponsors instead of to the carriers. So it needs to be said that this isn't a completely unknown. There are some plan sponsors who are recognizing that there's a lot of dollars that are afoot here in this float, and they're in a captive so that they can get the money themselves as opposed to having the carrier be the one to take the revenue off of the interest payments there.
On the flip side, there's been lots of success, I would say probably less around reform and policy because one, we know that all these mega entities have a lot of influence and sway, and two, policy's slow. And as obviously the good fight that, Ann Lewandowski brings to the table and what Chris Deacon posts about all the time, and a lot of this great and important work that happens gets tied up in the judiciary that is still largely, based on laws and policy and et cetera, but also opinion. And it's a slow and hard process. Again, some great things have happened locally in different states at the state level, but there's still been success when the employers step up because they represent $1 trillion in health spend. It's hard because there's so many employers who offer health plans and not all of them are self-insured and it's highly fragmented, but there are things that are working and bright spots that are emerging more and more. And the fact that you have this forum and have built it and have so many amazing people who work so tirelessly and fight for the betterment of the healthcare system. We just got to keep going. And I think we will eventually get there.
So it definitely sounds like we have pivoted, Preston, from talking about what the ways are that carriers may be making money that are surprising. And now we're into your advice, the advice portion of this episode. One potential way forward that could offer some positive here, which, as you said, is policy. And for example, Indiana is doing some interesting things relative to policy that are about hospitals, but they certainly have carrier implications. But then on the flip side, as you just said, policy, A, it's slow. B, it can become a quagmire of regulatory capture and special interest. Like, for example, Kevin Lyons posted on LinkedIn yesterday about a situation with the carrier in New Jersey who, is a major campaign contributor. Let me ask you something very specific. We talked about the 3 surprising ways that carriers make money. What's your advice to take that information on board? Like, okay, so now I know that my carrier is making money off of my money, right? Like they're making money off of my float. What do I do?
Well, I think the first thing that you do is honestly, this, and I don't mean it to maybe also sound like lazy advice, because it's not that, is go and find the right person or group who is skilled at building health plans for employers and have a conversation with them. To me, you could get lost in the days and weeks and months and years of fighting to get your data and trying to parse things together. And you could look at your healthcare spend, but do you know what you're looking at? Why are you call your broker? They're just going to try to keep you renewing year after year. So I think it's good to understand the concepts and then go find that expert. Go get a consultant, an expert who builds health plans for employers and ask them very straight, very forward questions about their costs, about the plans they've built, how much they've saved, how they build their plans, why they're successful, all of those, why they shouldn't work with their broker anymore. Tell me what a TPA is. Ask all of the basic pointed questions, but go find that person who's done this before and works with other employers in your area and has been successful doing it.
I think that's actually really sage advice. Andreas, Mang, and John Camire from Blackstone were just talking about this, in fact, a couple of weeks ago. Find someone who really understands exactly what's going on with you, with your plan. And then to your point, really dig in. And there's probably some red flags, which are out of the scope of this conversation. But like if you're working with a broker who's like, nope, you have to stay with your current carrier, they're probably getting a retention bonus, right? Like this information is out there. When 12% or 22% trend is something that you hear, it becomes even more and more important for the plan. It becomes absolutely vital for the plan to find the right person to be working with here, someone who's unconflicted, who you really know. What was it, Edward Deming? In God we trust, all else bring data. Like you have to have someone who's actually bringing the receipts, as they say, not just telling you. And just given the complexity of some of these games that are being played at this juncture, if it's your exact point, if someone isn't transparently offering up data as evidence relative to back up what they're saying, like be very careful. I think it's clear.
Yeah, better stated than I made it sound. So I appreciate it. And I mean, yeah, listen, it's any business, one of their single largest costs is healthcare these days. It's wild putting financials together and seeing what the cost is. Our economy is not going to survive healthcare. And one big way that we change that is employer groups to go take action, because they are footing the majority of the bill. They're also foisting costs on their employees that they can't afford.
Well said. So, Preston, where can people find the healthcare breakdown?
You can find it on LinkedIn. You can hang out with me there, or just head to thehealthcarebreakdown.com.
Preston Alexander, I have to say I love the healthcare breakdown, and I would highly recommend that anyone who hasn't been there visit Preston Alexander's Substack, The Healthcare Breakdown. Preston Alexander, is there anything I neglected to ask you that you would like to mention here?
I think we pretty much solved all the problems in healthcare. So I think
you know what? I think we can
dot
wrap
that
this
up.
And cross that
T. Just high five. Be like, man, healthcare's fixed.
That's right.
Easy.
Mic drop. Preston Alexander, thank you so much for being on Relentless Health Value today.
Thank you so much. It was a real honor. Pleasure.
Hi, I'm Dr. Stan Schwartz from Zero Health. Relentless Health Value has been a real source of insight and inspiration for me. Every episode feels like a thoughtful, informed conversation that really gets to the heart of what matters in healthcare. If you're committed to moving the needle in this space like I am, I strongly recommend subscribing to Relentless Health Value newsletter. For me, it's the best way to keep up with new episodes and stay connected. Thanks for listening.